Hello, good afternoon, and welcome to MF Corner on CNBC TV18. I'm Vinnii Motiwala, and thank you so much for tuning in. As always, this is a show where we focus on breaking down different kinds of mutual fund, what's trending in mutual funds, and passive investing. That has been gaining traction in India, revolutionizing how individuals actually approach mutual fund investments. Passive funds, as we know, are investment vehicles designed to replicate the performance of a market index rather than outperform it. To shed more light on this, what is passive investing? What options do you have as passive funds for you? What style of investing should you follow? What are the risks that are there as well? Talk to us about all of that today. We're joined by Pratik Oswal, Chief of Passive Business at Motilal Oswal AMC, to talk to us about all of that. Pratik, thank you so much for joining in with us this afternoon. Before we deep dive into passive funds, passive investing, let's just start with something on the basic front. Could you just explain us what are the types of passive funds that are available right now for Indian investors? I know ETFs, index funds, smart beta funds, fund of funds. There are so many options, right? So how do each of these differ in terms of strategy as well as risks and anything else that I've missed out on in terms of funds?
Yeah, thanks, Vinnii, for having me on the show. When it comes to, I think passive investing or passive funds investing, just to start with the basics, there's actually two types of, broadly two types of investing that happens in the mutual fund industry. One is, active funds and one are passive funds. What happens in active funds is that there's a fund manager who takes a call about which stock to buy, which stock to sell. So it's a fund manager's responsibility is, for them to generate the returns that you get, at the end of the day or at the end of the year. When it comes to passive funds, there is no fund manager. You're essentially, creating a portfolio of stocks that mirror the index. So I'm sure a lot of the viewers have heard about Nifty and Sensex. The idea behind the Nifty index fund or a Nifty 50 index fund or a Nifty 50 ETF is for the returns to be similar to the index. So if tomorrow the Nifty 50 index is up, say 2%, if you're invested in a Nifty 50 index fund on ETF, your portfolio will also be roughly 2% up. So that's the idea behind passive investing. It's sort of like an autopilot mode of investing, and it's garnered a lot of traction over the last 4 to 5 years in India. If you look at developed economies like the US or Europe, over half the mutual fund industry there is passive funds, and India also it's gaining some good ground. So we talked about indexes like Nifty, and you have a very popular index called Sensex as well. But there's indexes across all categories today. Today you have indexes that span international products like NASDAQ, S&P 500 indexes. You have sectoral indexes like, bank index, IT index, metals index. You also have a category called smart beta funds or factor funds, that we can talk about later. And also you have commodity ETFs like gold and silver. So essentially, today in India, unlike 5 years back where you only had Sensex and Nifty, you can really buy indexes across categories, across asset classes. If you see today, there are over 600 ETFs and index funds that are currently listed in India, and that number is only going to grow from here on.
Okay,
yeah.
So you're expecting this number to go on from here on. But Pratik, you were mentioning, right, FOF. What does that also indicate? What does that typically mean? Index fund is what you explained, right? If there's a Nifty 50 index fund you invest, that's going to be, the similar kind of return that you would get on that front. But fund of funds, what does that mean? And what is smart beta fund as well? How are these different? What is the strategy here that is followed?
Yeah, in terms of the different categories of, passive funds, there are different. So the two biggest types of passive funds that are available in the market today are ETFs and index funds. These are essentially mutual funds, but, they're slightly different from each other. And ETF is like a mutual fund that's listed on the exchange. So if you want to buy a Nifty 50 ETF in the morning and sell it in the afternoon, you can do that through an ETF. Whereas a mutual fund, you're essentially getting an end of day NAV. So you can only buy it once a day, and you'll get the end of day, value for an index fund. So that is the key differences between ETF and index fund. And the performances of these two are fairly similar. When it comes to FOFs, FOFs are essentially the full form of FOF is a fund of funds. What that means is actually a fund that where the underlying constituents are other funds. So for example, today, we have a fund of funds that can buy multiple funds and a fund of fund that can buy a single fund. For example, today, at Motilal, for example, we have a Nasdaq ETF, but we also want it to be accessible to our mutual fund investors. So we launched a FOF that buys into the ETF. So that's accessible to our mutual fund investors who want to buy a mutual fund as opposed to an ETF. You also have, fund of funds that buy multiple ETFs or multiple mutual funds. So today, there's a lot of fund of funds who buy, say, a combination of ETFs, say 3 or 4 ETFs in a single fund, or you have a fund of funds that invest into multiple asset classes. Like we have a fund of fund that invests into an equity product, an international product, a debt product, as well as a gold or silver product, all in a single fund. So the idea behind a fund of fund is essentially offering a solution, for investors who are looking at that category, or the other objective is to give a mutual fund option to anyone who's looking at buying a particular ETF.
Pratik, you were mentioning that index funds and ETFs are almost similar, right? Not a major difference. But if as an investor, I have to pick up index fund or an ETF, what is the better option, whether it's liquidity, costs? What is it that is suitable? Or is it more goal-oriented suitability? How does this work then? How do I differentiate?
Yeah, so that's that's an excellent question. So essentially, passive funds come in two formats, as I said, ETFs and index funds. ETFs are, the full form is exchange traded fund. So it's actually a fund which trades on the exchange. So essentially, the positives of an ETF is that you can buy an ETF off your demat account. The second positive about an ETF is that if you want to lock into a certain price at a certain time of the day, you can do it through an ETF. For example, if the ETF is trading at say 10 rupees right at this point in time, you can actually lock in that amount by buying an ETF, as opposed to and ETFs. So a lot of traders and a lot of sort of institutional investors tend to prefer ETFs. But what we've seen in India, unlike the US where ETFs are very popular, index funds are actually a preferred mode of investment by majority of the investors. We've done a survey also that says that index funds tend to be a lot more popular because they are a lot simpler. You don't have to have a demat account in index funds. You can set up SIPs with a lot of ease in index funds, and also you don't. The problem with ETFs currently in India is that ETFs do not have as much liquidity on the exchange. So when you're buying an ETF off the market, say NSE or a PSE, then you have to buy it from someone else. And what normally happens is that in India, the liquidity for ETFs is very low. Okay. Essentially what that means is that when you're paying, so the ETF price is 20 rupees, you're essentially paying a slight premium, say 20.1 or 20.2 to buy the ETF because of the lack of market around it. So the problem in India is that liquidity for most ETFs, barring the top 3 or 4, is actually quite low, because of which, a lot of investors tend to overpay for ETFs on the exchange, and also they get lesser amounts when they're selling on the exchange. So for investors who like ETFs, we would advise them to look at something called an INAV, or that is the full form of indicative NAV, which is basically the live price of the ETF. Make sure that when you're buying an ETF, the price you're buying to is very similar to the INAV, which you can get on the website.
Okay. Pratik, thank you so much for explaining us so well and simply put, what one could look at. But what if goal-based normally investing is what you talk about. Everyone said that you should have a goal and then decide how your portfolio actually shapes up. But for, if I'm adding passive funds in my portfolio as well for specific goals, how should that be going around, right? What is the blend that I should be having in terms of maybe large cap index funds, short-term debt ETFs that are there? So what is that combination and how does it differ between goals?
Yeah, so, basically the way, at least, we see passive funds are simpler version of, actively managed funds or simpler versions of mutual funds. So today, if say a investor wants to, buy into a mid-cap fund, there are about 30, 40, 50 mid-cap funds out there, but you could easily buy the mid-cap 150 index fund, and, that's done for you. So essentially the thing about goal-based investing is that, goal-based investing is essentially building a portfolio, I think in accordance to sort of goal you have in the future. So I think the asset allocation really matters when it comes to goal-based investing. If your goal is, say, retirement, then you could have a lot higher equity proportion of your goals. So suppose you're saving for, say, 30 years, suppose you're saving for retirement as a goal, then you could ideally have a 70-80% of your investments into equities, versus if you're, say, buying a house in 5 years' time, that you can't really have an equity of 80%. You'll have to come down to, say, 20, 30, 40%, because obviously equity tends to be a lot more volatile. So we believe that your asset allocation should be defined by your goals. That's number one. And number two is that when you're looking at passive funds, the best part about passive funds is that you're really able to find simpler solutions for all your investments across asset classes. So today, suppose you wanted to buy a commodity fund, you can buy it through a passive fund. Suppose you wanted to really buy a fixed income fund, you can buy a passive fund. Suppose you want to buy a mid cap fund, you can buy a passive fund, also international. So when it comes to your overall asset allocation needs, the beauty about passive funds is that you can really keep things very simple. The other benefit about having passive funds is that you don't have to really worry about performance. So I think you'll never see underperformance in your portfolio. And what we've also seen is that passive funds, unlike the past, today have become very efficient, and also they tend to be very good in terms of so also giving returns. So investors don't really need to check their portfolio every 6 months or every 1 year. They can just forget for life. So that's some more benefits about it is the long-term goals.
Absolutely, long-term goals. I was going to come to the return part as well, because that's what attracts any investor, right? You want the best return whenever you make an investment. Long-term, I just want to understand passive funds versus active funds. What is the return in comparison? Are there times when we've seen passive funds actually outperform in terms of active fund returns? And given, that market volatility comes into play, right? So if it's an exchange-traded fund or an index fund, then when you're seeing such a time, that could see that impact coming in as well, right?
Yeah, so the performances differences between ETFs, which are exchange-traded funds, and index funds are pretty much the same. In fact, there used to be I would say bias towards ETFs, because people used to say that ETFs are more efficient. But actually now the industry has come to a conclusion that it's actually not, as if they both are exactly the same. So essentially, investors should choose passive funds on the basis of convenience, as opposed to what is better or worse. The second is that what you said right now about performance between active and passive funds. I'll be honest. We used to have this huge debate about 4 years back when I initially started launching funds about active versus passive. Do you have alpha? We don't have alpha. So there was a lot of debate. I mean, especially on these shows on what should you buy versus passive. And I think the really beautiful thing about what has happened the last 4 years time is that people have come to a conclusion now that you need to have active and passive in your portfolio. Fair and simple. So I think a lot of our investors, a lot of our distributors, a lot of our partners, almost everyone we speak to on a daily basis has come to a conclusion that 20-25% of the portfolio could be in passive funds. I think what the industry has also realized is that the large cap portion of the portfolio is where underperformance tends to be the highest for actively managed funds. So that portion can go into say a broad-based index or maybe a smart beta index. The third thing is also the rise of smart beta funds or factor funds. I think we are talking about underperformance and outperformance. There's a category called smart beta funds, which 3 years back was under 1,000 crore in assets. Today they're approximately 45,000 crores. So it's a very silent, growing category. It's the second biggest category in the world. Almost $4 trillion are invested in smart beta funds globally. Actually, no, not globally, just in the US. So I think it's a very big category, and a lot of people are sort of, taking account of this new category where you're able to get the transparency of and pricing of passive funds, but the outperformance of actively managed funds. All the smart beta funds in India have demonstrated outperformance over the long term. So people are also looking at these strategies going forward.
Absolutely. Interesting strategies there, right? So for long term, so far we have said that, you could look at those Nifty 50 or Sensex, Nifty 500, great choices coming in on those kinds of index funds as well. And other options are also there, like you mentioned, the Smart Beta Fund and international passive FOFs are something that is interesting. But on that note, viewers, we're going to slip into a very short break. We still have Pratik with us after the break to discuss more on passive investing, passive funds. So don't go anywhere. Welcome back to MF Corner on CNBC TV18. Today we're discussing passive investing, passive funds with different goals, how you should be looking at passive funds and passive investment. For that discussion, we still have with us Pratik Oswal also, who's here. Pratik, while we spoke so much about long-term investing, goal-based, but what if I'm a short-term investor? I still want to invest in passive funds, or medium-term is what my goal of investing is. Is there an option still for an investor to look at the passive funds? Is it a good bet, or you would then say, because you're a short-term investor, better to move to active?
Yeah, so I think depends on what short-term to medium-term means. I would say anyone looking at under 3 years should ideally not look at equities as an asset class, either active or passive. I think equities is a very long-term asset class. In fact, even 3 years might be too less. Maybe if you look at it from a 5-year perspective, but essentially you could play two ways. One is by asset allocation. If you have a say 3-year timeline, which I think is a medium-term sort of a goal, then you should look at maybe allocating a small proportion of your money in equities, and the balance can go into say fixed income or gold or something like that. So that's one way of playing a sort of short to medium term sort of a goal. If your goal is under say maybe 1 to 3 years, then I would say like an arbitrage or a liquid or maybe medium term sort of debt instrument can be a good way of sort of playing through passive funds. You have today liquid funds that are available on an ETF format, which are completely passive. You also have arbitrage as a category, which is not passive, but that is really rising as a category because of its tax advantages over say something like a I think liquid fund. So we would recommend to look at more fixed income instruments for short-term goals, whereas medium to long-term, I think long-term can be majority equities, medium-term majority fixed income. That's a good way of playing it safe, because what happens is that markets are very volatile, and when you complete, say you have a goal in 3 to 5 years time, but what happens if there's a market correction in 3 to 5 years time? Because you can't predict these things, and that you can sort of do it with an asset allocation decision.
Okay, Pratik, what I want to also understand is in terms of how passive funds can be used effectively for two. One is wealth preservation as well as versus wealth creation. Which type of funds actually align these objectives, that if you have two of these?
Yeah, so basically, I think there are I think the good way of, so let's talk about wealth creation.
Yeah.
I think wealth creation happens in equity funds. I think within equity funds, I would say there is higher wealth creation happenings in something like a mid-cap index fund or a small-cap index fund. We also have a micro-cap index fund now, which is quite popular with investors. So I think wealth creation can happen through equity funds, and that could be large, mid, small. You can have international index funds like investing into a NASDAQ or an S&P 500. So those are excellent ways in which you could create wealth, given that you have a investing horizon of say 5+ years. We would even I think for investors who are slightly more I think advanced, who are looking at smart beta strategies, they can advance or maybe if they have the risk profile which matches a slightly more aggressive behavior, then you can also look at smart beta funds. There is a strategy called momentum, which is extremely popular today. There's a lot of investors who are buying momentum based strategies today. So that's a strategy which has worked really well in the past, and I think those are good for slightly more aggressive investors. If you're looking at wealth preservation, I think fixed income passive funds, and also I think commodity funds, or maybe a combination of different asset classes, could be a great way to build portfolios. If you look at investing, a lot of people want to sort of diversify their equity funds by buying multiple equity funds, and that is not the best way to diversify, because what we've seen is that when markets correct, all 5 of our equity funds will go down. Whereas the best way to diversify is to actually diversify across asset classes. If, for example, if you had a good allocation towards, say, equities, fixed income, gold, and international sort of funds. These are four asset classes, and what we've seen in history is that all four asset classes are actually moving. They have good returns over the long term, but the rise and falls happen in different moments in time. So,
Sure.
for example, in the last 1 year, gold has done extremely well. I think it's delivered something like 35%, whereas equities has not delivered as much. Even fixed income has not delivered as much. International funds have done very well because the Nasdaq has done very well. So essentially, if you're able to build a portfolio that's diversified across asset classes, you're essentially trying to negate the downside of an asset class by the upside of some other asset class. Just to give an example, again, and this concept is called correlation. And we believe that if you have a portfolio that's very uncorrelated, that is an excellent portfolio because you're essentially long-term returns tend to be the same, but the returns are uncorrelated. What means that when markets fall for one asset class, the other asset classes sort of help defend the fall, or they might move in different directions. So I think as the passive funds today are available across asset classes, and I think investors today can really build these portfolios across asset classes, which will help them with their wealth preservation needs.
Okay, Pratik, what is the best time to start investing in passive funds? Is it that, when you start seeing volatility, people realize, oh, I should maybe start doing more passive investing, or maybe look at something like that? But what is the best time for investors? Maybe who are more cautious, or anything in terms of timing?
Yeah, so it's very interesting. So we did a study. In fact, we did a study last week where we looked at. So we're seeing some stoppages of SIPs. Small number, not very big, but small numbers of SIPs. Coming in from some of our investors in our AMC, and the idea was to do a study about when is the right time to start an SIP. And what we saw was that it was. I mean, it was sort of in line with what we thought. That if you have an SIP of, if you have the best days in the month, and if you start an SIP then, or if you invest in the best day every month, what would the returns be versus the worst days in a month? What would your returns be if you invested in a high PE scenario? Say the PE is about 30, 35 versus the price to earnings or is say 15 to 20 when the markets are very, very, very cheap. And what we saw is that over a 10 to 15-year horizon, which is essentially, a long-term horizon, or even a horizon which is 7 years plus, the returns are pretty much the same. So even if you start an SIP at the peak of the market,
Right.
As opposed to trying to start an SIP at the bottom of the market, your long-term returns are pretty much the same. So we believe that when it comes to SIPs in general, I think it doesn't really, matter when you start an SIP as long as you start. So, and also, if you are, what we've also seen is that, stopping SIPs and restarting SIPs
Right.
is also not value accretive. When it comes to lump sums, we do feel that over, say, I would say over, say, a 7-year plus journey, regardless of when you enter, you will make some money, or your returns will be positive by a certain percentage. So I think, if you are investing in a market today, or if you invested in last year, the markets were expensive, you really have to give your investments time. And once you give time, you'll always make money. So I think that's the, similar sort of philosophy, when it comes to investing I think also categories matter.
Sure.
So see, small and mid caps will behave differently.
Right.
But if you're able to just, have a long-term horizon,
Absolutely.
fine.
Absolutely. Long-term horizon is the best thing to go around when you're investing, and the time in the market is more important than timing the market, right? So Pratik, thank you so much for joining with us on the show and giving us your time this afternoon, explaining our viewers as well about passive investing, passive funds, and what options they could look at in terms of goal-based investing as well. Thank you so much, Pratik, for joining with us. And viewers, thank you so much for tuning in to MF Corner on CNBC TV18. We'll wind down this edition. Thank you so much from the team who put the show together as well. Up next, your closing bell.